just let me briefly introduce our community, and then I'll get into our amazing discussion for tonight. So we are the CMU Tech and Entrepreneurship community, which have about 7K alumni at this point in time. And we actively organize various virtual as well as in-person events, including various happy hours in the SF area as well as in NYC and few other cities. And for tonight, we have our startup school event series event on how to build a winning startup. In this case, we'll hear from Ross Fubini, who is the managing partner at XYZ Venture Capital, and he'll share with us the checklist for the early stage startups. And just to highlight a few of the very popular and successful multiple billion-dollar companies that XYZ Capital has invested in, including Anduril, Volcata, and Newfront Insurance. Ross is also featured on the Forbes Midas seed list for 2022. And with that, I would like to ask Ross to do a quick introduction, and then we can get into our fireside chat for today.
That's great. And guys, thanks everyone for spending the time with us here. It's exciting to see so many CMU alums. I'm a CMU alum, though, class of 98, so maybe a few years older than a couple of you. But really, really excited to be here. Maybe I'll make just two comments about background. First, I run XYZ Venture Capital. It's a firm I started in 2017. It's about $500 million under management now. And then most of the stuff that we've done has been in the fintech and enterprise space. And thanks so much for sharing some of the highlights, a set of businesses that we've gotten to be involved with since their very early stages. Anduril, which is a multi-billion-dollar defense contractor, Volcata, somewhere in the camera space, Newfront in the insurance space. The more recent businesses like Sardine, which is very large and high scale fraud and payments company, which has been quite exciting to see build out. Switchboard, which is a new Zoom competitor that's also been scaling aggressively, and thankfully, a really rich set, about 85 different portfolio companies. All of the companies that we get involved with, we start working with its earliest stages. So as a VC, the part that I like and have come to enjoy the most is really being intimate with the formation of a company, which is 2 to 3 people and an idea, and maybe hints at execution. And with all these businesses, then be able to be part of them, scaling up to, in some cases, really, really great scale in terms of revenue and valuations. In terms of just, lastly, in terms of background, my own experience, I grew up in Virginia, outside of DC. I saw some DC names roll by. I started my career as an engineer. I'm a computer scientist, graduated from the CS school out of CMU. As I said, in 98, I originally came out to the Bay Area about 20 some years ago then for Netscape, where I worked on the core browser, the security system, which a company that came out of the Netscape diaspora called Tellme in the .com days. Ended up running a division of Symantec, about $500 million out here. And then I started a company raising my own venture money in the enterprise collaboration space. Sold that business to SAP by way of SuccessFactors. And that was all about 13 years ago. So for me, that's where I then started, really stumbled into venture. There's a guy named Mitch Kapoor, some of you might know. Mitch was the founder of Lotus Notes, and really a tremendous early stage investor before that was very common. And so I worked at Kapoor Capital for a number of years, working on companies like LendUp, Twilio, Optimizely, again, all first money investment in them, Formlabs, really, really terrific groups. Then I moved to a group called Canaan, which is a $6 billion multi-stage firm. And I left that and I started XYZ, and I had also started a group called Village Global as well. Ran both those firms for a while, and now just run XYZ. And as I said, just really excited to be able to have this discussion and talk about early stage company building.
Awesome. Yeah, so that's great to know. Perhaps maybe you can shed a little bit on the name XYZ. I think that's also quite an interesting story, maybe for many of our audience members.
Oh yeah, so I'm pretty nerdy, and I was born into it directly. My great grandfather, if there are any mathematicians in the audience listening to the recording, is a very famous mathematician. Has this thing called the Fubini theorem, and it's how to use basically reduce integrals of non-Euclidean geometry and Euclidean geometry. And he was the primary mathematician with Einstein. My grandfather was very close to, so his son was the primary, he was the Assistant Secretary of Defense under Kennedy and Johnson. He started ARPA, DARPA, the Defense Science Board. Now, unfortunately, because of the regression to the mean, that means that like my accomplishments are down like several orders of magnitude, and my kids might touch bottom. But it's exciting for me because XYZ. If you guys go to XYZ.vc, you can see my great grandfather's sweet mustache. Guido Fubini really just kind of crushed the facial hair as well as the mathematics. And XYZ is really a nod to him and that mathematical history. We have it captured some of our content even about the fun, talking about position, velocity, acceleration, which is kind of a nice quip, but it really points back to the history of technology and the history of math and core science. It's underlying so much of what I like about venture.
Yeah, that's definitely very cool. And it's great that you shared that story with us. And I think now we'll be going into our discussion about how to build the winning startups. So what we can do for this part is we will have it split across two examples of different companies, and we'll dive in more deeply into each of them. So first, I think what we can do is start with the founding story for Newfront Insurance, and then we can get into follow-ups on that in a bit.
Yeah, and really excited. There's this, every startup is just so damn hard to create, and they're really just a force of will. Newfront is one of my favorites because it both had a very deep original idea that's present, and then lots of twists and turns that changed to its state now. Newfront's valued about 2.2 billion. Its last round of financing, it has several hundred millions of dollars in revenue. It's profitable, which is a great thing to be in this, this market where growth is a little bit harder to come by. They do something that's incredibly boring, but is present in every single one of our lives and in the rooms you're sitting in right now, which they provide commercial insurance. So commercial insurance are things like workers' comp, directors insurance, and it's basically saying that every business from the O back in Pittsburgh before it closed to a WeWork to the people that built the house that you're sitting in have to have. Now, the original idea of Newfront Insurance was there from Spike and Gordon the absolute beginning, and it was that there was an opportunity to build a technology-powered commercial insurance brokerage. Because I will tell you, if I say the word insurance, I think insurance and technology, what you would imagine, sort of like the movie Brazil, the sort of like the insanity of paper and fax machines is just absolutely correct. That is what is going on currently in commercial insurance. It is a crazy, insane, slow-moving, backwards universe of paper pushing. The idea of Newfront Insurance was, could we automate those processes? So if you're going to go build a 10-story building, or you run a fleet or a factory, we're going to be able to make it easy for you to show up and say, hey, here's my business. I need workers' comp insurance to protect all my people. I need a claim system for, when my brother's a builder. So always imagine that person puts their nail through their hand, which happens more than you would think on a construction site. Do claims management. We're going to power all that. So the idea was there in the very beginning. For me as an investor, I basically believed in Spike and Gordon. They're a young, very, very talented team. Spike had a kind of classic business background since he'd been head of biz ops at a few different startups. He'd gone and gotten his MBA at Stanford, Penn before that, sort of like all the sort of check boxes of life. And Gordon had been a technologist, sold his previous company to LinkedIn after 2 years, still very early in their careers. And they were people that I thought had a real ability to build the technology here. The thing that was most fascinating was they then got the go-to-market essentially completely wrong. They wanted a Y Combinator, which some of you guys might know and considered joining or maybe even attended. And their premise was much like a Brex or a Stripe, we're going to go build commercial insurance solution for startups. Because as I said, every single company has them, including every startup. The interesting thing is like that was actually the wrong go-to-market in many ways in terms of the long term, because those of you that run startups, people don't give a crap about commercial insurance. It's small dollars. It is not the highest order bit. You care about Stripe because you want to take payments. You probably even care about PagerDuty because you're, a nerd. You wrote your software. You don't want it to go down, or if it does, you want it to wake you up in the middle of the night. But you do not care about really your commercial insurance because it's small dollars. You kind of just use whatever's offered to you and you get off and going. It's nice if it's easier to use, but it's not really transformative business. And that was really the first phase that Newfront went through. The second phase was they had an awareness that the brokers out there that were doing all this commercial insurance work were really they hated having poor technology as well. They didn't like that when their clients had a claim, there was all this pain and paperwork to get paid if someone got hurt on site. They didn't like that pricing was opaque because of the process of quoting out business. So they started going out to brokers that already managed existing businesses and getting those people to move over, with their $4 million, their $10 million, their $2 million book of business and bring that book over with them. And that turned out to be a really exciting initial business. And that was the first phase of the company. The second phase, which you can't think about Newfront without queuing on to, is the executive team they brought together. Because what they're doing, very technically and operationally hard. They had Gordon anchoring the technology side. They brought over a guy named Mike Brown. Mike Brown joins the COO. Mike previously ran all of Uber Asia. This is still a very early stage team. And in many ways, one of the things that was quite exciting was that these really exceptional people, Mike ran billions of dollars for Uber, wanted to join. They got wooed in because the opportunity was just so big, and good people beget other good people. And so that was the second stage of the business, is really being able to form up to scale. And then lastly, Newfront acquired a series of large brokerages. And we could go into some of the details of why this makes sense. The quick version of it is that the job is basically the same for every broker out there in the world. You'll go and find business and fulfill it. But so Newfront could be an incredible platform to bring more brokers onto, including just by acquiring the whole brokerage. And so that's led to the company just scaling up pretty dramatically, and then capital to go do that. So what started out as this core insight that the team had in the beginning, both about the ability to use technology to make different parts of it operationally effective, and the fact that these commercial brokers were not something you were going to disintermediate in the market, but instead you were going to serve user and technology platforms. They ended up being the core insight that runs the full thread of the business, in addition to the exceptional people there. So it was just a really exciting business to go build. Lastly, as an investor, I'll tell you, it's the kind of thing that we and me just deeply love. What you started with was like, there's a massive category, right? It's a big business. So you build something that matters. You got lots of space to go around and expand. The second thing was the team had this, from its earliest days, they had an insight around how the market could change. And I even had my original investment note was, worst case, there was going to be a technology-powered, commercial insurance brokerage. So that insight was right, even if the way they went to market changed, as I just said. The last thing, so big market, true insight that they're going to go play around with. And then lastly, just to execute like sons of bitches. Like, this is like one of my core beliefs. If you just like put one foot in front of the other faster than everybody else, you learn faster than everybody else. That's how you're going to be successful. So we've seen that at Newfront, we've seen that at large companies like Palantir. We continue to see that at small companies in our portfolio. And the thrilling part of that, it means if you've got those attributes, you've got an awareness of a big market that can change. You have an insight, about how or that business is going to pivot, something you can do that's new. My belief is if you've got horsepower, if you've got execution velocity, you can navigate most of what life throws at you. And it's been a really exciting business to build with them.
All right. Yeah, that's definitely a hell of a journey. So the other part which we can dig a little bit deeper is on the earlier stage of this company, as you walked us through the different phases that it went through. So more specifically, you talked about the go-to-market that they had when they came out of YC, and then they had to eventually go for a different market segment. So maybe you can touch a little bit more on that, how it relates to the XYZ's capability as well, and where XYZ was able to come in and make that transition smoother for the company.
Yeah. So, and we should never make any mistake. So you commented on something that I feel that's specific to XYZ, and then we can use to color out the companies that we've gone through. So my view, and it comes from having done venture for this decade plus, is the thing that I am uniquely good at, the thing that I can bring to a boardroom, a sync, a founder discussion, is perspective. And that's perspective is about what do we need to do to really remove risk and unlock the next round of funding. It's a pretty old school view of venture. It was my job is to help the company raise the next round of funding. Now, to your point, the company knows more about their market than anyone else does. So the Newfront team knows about their insurance market. We just recently backed a company that's like a Datadog that does performance management of live models out in the market. As an example, announced, quite exciting. And again, that team knows more about the technology, knows more about how to get to the run time than we're ever going to know. The thing that we know, the thing that I know, is what the company needs to look like as that business scales up. And so in this case, distribution was the core thing. So as an example, in Newfront's earliest days, the idea of like we're going to get these hundreds and thousands and tens of thousands of companies to adopt Newfront as its commercial insurance, that was the original thesis. Now, in parallel, keep in mind that we're building out all the functionality to go and serve larger customers and larger brokers. But that was the original premise. Now, the team, as they went and executed this, what they were discovering is that they just, customers, again, they're interested, like they'll take the phone call, but they don't really care. So, and that was what they were looking for, is they wanted distribution where that customer really cared. And that was then led to their second insight, which is the brokers, the people that were already selling insurance, they cared immensely because they wanted to do a great job of selling to their customers. They wanted to do a great job of selling to the commercial insurance to those businesses, and that Newfront could be a super power for that. And that's constantly what we're looking for. We have another company called Mosaic. Mosaic is a company that sells to CFOs and founders a product around financial planning. Interestingly, when they were first starting off, they built a really beautiful product. They integrate Salesforce data, HR data. It can show you how you're spending money all through your business. It's mosaic.tech. There are a bunch of mosaics. What they found out interestingly, and again, deep understanding. The team was former Palantir finance team and just unbelievable execution velocity and building. But what they ended up finding is when they went and talked to early stage companies, they really liked what they were getting because it was reporting financial data, but it wasn't worth that much money. It was like maybe, I can't remember, worth 10, 15K. And what happens is the cost of sale is just so high to offset those small ASPs. It's doable, but it's a pain in the ass. You can probably build a low-end business there, but it's really quite hard. Meanwhile, all the even Series A, B, C stage companies we're desperate for them to build planning. So what's planning versus reporting? Reporting just says what happened. Planning is like, hey, the market's collapsing. I got 10 million in the bank. How do I plan out my head count based on a bunch of assumptions? I got 25 million in product I'm selling. Here's my expected selling rate. Well, so that team that built a very, very complete planning product and has just gone farther and farther up market, where now they're typically selling to people in their Series C, D, public company phases over time. And so that was the trajectory of that business. They do all the damn work. I'm coming in and helping them think about who to maybe hire, how to close those candidates. But really what I'm mostly doing is working with them around the observations around that initial market fit, which then comes all the way down to like, what features are we building? How fast can we deliver stuff? And frankly, how much money do we have to accomplish which goals? And so that's, again, every journey I think begins for us with this deep insight, and then like, what are we doing now, and trying to find real velocity in the go-to-market.
Yeah, that sounds really powerful. So perhaps as we are transitioning to a more earlier stage company at this point, I think it would be good to know what are some of the aspects that you are looking in some of the early stage companies that pitch to you. I think you had mentioned sort of the checklist in terms of the background.
Yeah.
It would be good to know the other aspects that you look for as you are making some of those decisions.
The good news is this is like where the checklist begins and ends. I can walk you through some of these examples. Recent ones, we did a company called Sardine. It's ended up growing very, very quickly, but a year ago it was a tiny thing. And Sardine was started by the head of AML KYC at Coinbase and Revolut. And he had an idea for building a new fraud system. And frankly, at the time that we did the investment, I wasn't confident that his fraud system was going to work better. So this is in this financial transactions flow through it. You could identify fraudulent transactions. But what I did believe is that he was so capable and so sought after. He was able to get into the flow of a series of customer transactions. So what happened to me is literally I was underwriting him. The fact that the current solutions are terrible. There's Riskify, there's SIF. They're not bad, but they're not particularly great. I thought you could build something like truly, truly great, and that he had a bunch of relationships. And don't think like BD, fancy, everyone wears suits at dinner relationships. He was a nerd that built this stuff at Coinbase. People knew it was really hard, so the teams at Chime and Brex and everybody wanted to have conversations with him. So the basic premise was that he could be able to get in the room and build something that mattered. Now, that company ultimately, found product market fit because the technology they were building was just better. In terms of it was better for a bunch of financial services, financial services companies and new fintechs. And it was really bad at working with crypto companies. Not because anything magical did with tokens and blah, 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 we all get rich quick, but because it was really good at the device identification that was happening for digital financial purchases, which is basically all of crypto. So it got those two accelerants. But that was the goal, and that was the process, is really just getting it with these customers, trying to get into the core flow of their decisioning, and then prove that their product was better. And then once we had that proof it was better, it's just a matter of like going out and talking to those different customers. I'll give you another example, a Switchboard. I mentioned it before, and it's mostly to stay in the same set of examples so we can kind of hold our brains together. Switchboard is a new Zoom, and it's more than new Zoom. If you'd see it, we could host this event here, but instead of your or my faces staring at each other, it's an infinite canvas where all of us could put in browsers and we can all browse them together. So when I'm talking about this company, you don't watch me hand wave or look at a static presentation. I can show you a browser. Or if you're doing a regular engineering sync, maybe you've got a browser with your Asana tab and your Jira work list, or your action items to do, or a Google Doc you're working on. So you can see all this content together. And much like a Slack room, it's persistent. So unlike this Zoom, we're going to end it, it's all gone. Here, there's a consistent room you come back to. So this company began in a similar fashion. Amir, the CEO, said a deep belief there was a better experience to build around collaboration, that these talking heads was not sufficient. And the idea he had was pretty hand wavy at the time, but it was one that I also believed in, having built a bunch of collaboration companies, was that there was another layer of functionality to be built across web properties. You could see it in Quip, you can see it in Google Docs when you're all in there working together, but somehow that collaboration wasn't connected to Zoom. Yeah, it's happening at the same time, but there's something missing there. And the journey of Switchboard was really just going and trying to figure that out. And both, we had some wrong ideas in the early days. We thought a good use case would really be education and teaching, because we were looking for examples of where people are working together to get better at something. Like, I'm going to teach you guitar. And we looked at all the different applications that you could add into this static environment. But Amir kept grinding away at the features and functionality. There's sort of two inflection points for the business. One was where they did this infinite canvas. So we've been working on the browser. That's very hard to make a shared browser that's in the cloud that has access controls and things like it. But the infinite canvas suddenly meant like we're working together, and you had space to move around, and once you had infinite canvas, the idea that canvas would be persistent was a really powerful idea. And so that was one inflection point. And then the second inflection point is really a focus on enterprises and what's called product-driven growth. A lot of you probably know that, getting bottoms-up adoption, Dropbox style for the product. And so they've launched recently, and they're now in this process of figuring it out. But they haven't figured all those things out yet. But boy, do customers love the initial use case and love the initial adoption. And that's exciting to go see happen. But again, it started off with this initial idea of a better solution to be built in something, and then the iteration of features that end up catching in that process. And that's what we're doing at Dynaboard, which is the new Visual Studio, new Visual Basic we're building. And again, it's a great technology that we've launched, and we're trying to learn live with our customers exactly what are the repeatable use cases for that business as it's been scaling up. It's the journey of essentially every company. It's each one's hard, but it's listening for that constrained problem that you can uniquely solve.
Okay, yeah, that insight is definitely appreciated. So let's get a little bit more into one of the companies that was started in-house. In this case, it's Sanlo. So I think that would be very helpful for our audience if you could share how they started in-house and how they founded, or let's say how they met other co-founders and so forth.
Yeah, and so the founding process is always really interesting, because about like 80% of the deals that we do are ones that come to us, like, hey, you've got an idea, we're raising, whether it's $1 million or 10 million. We've got some customers in the beginnings of an approach, and we're going to go write a check against that thesis. So formation things are the rest of the businesses that we've done, and I love them because it's the true creation process. In some cases, they are ideas that I have had, and I've turned to a couple of customers and said, hey, I want to go work on this with you. And in some cases, it's people that are coming into our orbit and they want to work on a series of ideas with us. But that's the difference between formation and like a traditional seed. It's just like level of involvement. I just happen to like it, and we've started, as you said, about 6 companies. Sanlo was an example of a woman named Oya. Oya had been an executive at a game company, at a fintech company on the product side. And truth be told, she is so incredibly talented. She wanted to figure out more about venture and how venture worked. This time, actually, XYZ itself was a startup. We were just figuring out, like, what are our repeatable motions? How do we serve our customers, founders well? And so Oya was kind of to come in, and we really said, like, why don't you come in here? I'll show you how venture works, and you can see if you like it. Now, what Oya ended up finding out is like venture is basically sales. I mean, who the hell wants this job? It's the worst. No, it's the best, but it is definitely a sales process, and is a certain kind of you're building many things a little versus one thing a lot. And what Oya had a deep insight on, had a personal insight on, was that she wanted to go and build her own. The sort of second phase of her thinking, so she had come in as an executive in residence, decided she's going to go build a company. And the process that she went through was that she wanted to first to really get to very clear details on the product that she wanted to build. Now, thankfully, she, because of her gaming experience and her fintech experience, was able to put both those ideas together. So I want to go build something in operational tooling for games. And so she started talking to all these different game companies, trying to figure out what was the missing need. And this is not an uncommon process, so much that it's basically every founding process I've ever seen, which is you create a very, very, very tight set of constraints and talking to this kind of game company, this kind of scale. They do or don't have, in her case, a CFO or a finance team. And you're trying to understand, like, what are their pain points? And the pain point she found was really around funding user acquisition. So she went to game companies and realized that these folks, once they had a model for how to cost effectively monetize users, is a real pain in the butt for them to go raise capital. And in particular, it was really difficult for early stage businesses or even sort of new studios within larger game companies to raise capital. So she had discovered this was the product she's going to go build. We're going to be in the runtime with game groups, and we're going to build a system that, based on that information, we can go ahead and give those people money. It's sort of similar to a company called Pipe that some people might have heard of, but applied specifically to gaming. Below the covers, as a team, it was really her. But then she had a CFO she was working with, and she went through the process that so many different people do, which is that person was going to join. They're doing a lot of work. Then they decide like it's not the right fit for them. And then all you did, which is probably the most common pattern we see, is someone else out of her network, heard that she was working on an idea, it had some momentum, and she's able to bring in her technical co-founder, who was just absolutely tremendous. And then that became the founding team. And I can't remember if we backed that before or after he joined. I mean, we knew it so intimately, it was indifferent. I mean, Oya could have discovered she's going to build a toaster company, and I would have been enamored to do it. But that's the process most people are going through. We just have an associate of ours that's doing the exact same thing. And you can imagine, as an associate in a venture firm, you're not only like busy like office hours jobs, but you're seeing like all these other companies. So how do you decide where to focus? And so the discussion I had with her was the same, which is just to have a thesis, which is like, I think these customers have this need at this stage, and I'm just going to go out in the world and talk to them. And you're basically, you're almost uncomfortably constrained as you go and look for the product problem you want to solve, because you don't want to find a space. You want to find a thing you can do. Because if you can find that, then you can find two customers. You can usually find 20, if not 200. And then you can say, hey, this is a place that I'm going to go start. Now, she had a bunch of constraints she really cared about with respect to climate. We have a lot of beliefs about the opportunities around fintech and climate. And so that made it a great opportunity for her. But it's the same thing everywhere. Coming to ours called Stir that we started because I believe that creators like YouTube or TikTokers need better tools in finance because they're really small businesses. And one guy introduced this incredible guy, Joe, the CEO, joined and led Stir, and went and found the payment splitting and payment management was the thing to go do for all these folks. It actually wasn't even what I thought it was. I thought what they wanted factoring. But again, he found what they really wanted wasn't factoring for easier access to cash. They wanted more easily to be able to pay the people that worked on the YouTube video contact for them. And so again, he went through this hyper constrained process, found that's the solution. We're going to pour more money, in this case, through Andreessen Horowitz, against that problem and scale up. And that's what I've seen people go through, is these very hard phases of like, well, what do I believe I want to go do? And then who am I going to go do it with? And neither of them are straightforward. In fact, they're both the opposite of that. So you kind of create a process that funnels your time and energy. So you come back with both the thing to build, and in some cases, a team to go do it with.
Okay, yeah, I think that would be quite helpful for a few of our future founders here. So we can see almost two recurring themes. One is a cross-cutting aspect across fintech, and the other one is serving business customers. And the other part, which would be very valuable for our audience today, would be identifying what's the right number of customers to talk to or have interest with. So I remember I think it was for Sanlo that you mentioned, they identified this niche, let's say, problem that they wanted to go after, but then they looked at 220 or 200. So what's the right number? And since this is such a iterative process, how do you advise companies to, especially in the early stage, to make that, let's say, trade-off decision?
Yeah, so the process that people will walk you through sometimes, where you're like, well, what's your TAM? And they're like, well, the market's this big, it's $160 billion, and just in the US, it's 69 billion. And if we get 2% of just the folks that live in California, we're going to be worth $1 trillion, right? It's a common approach. It's absolutely useless. I mean, when you're starting a company, it's like you're sitting here with like there's water and there's dirt, and you're trying to make mud. You're trying to like build the initial thing. So to answer your question, the approach that I've seen to be the most helpful is to come up with these highly constrained sets of rules that become the customers that you want to approach. And so just to stay in the Sanlo example, so they were looking at these early stage game studios, and the question was like, well, how much scale do they have to be? If it's 2 people, well, those people are just kind of struggling to see, is this a business or not? Or maybe they have a cool indie game where everyone's getting paid, but it's just not that much scale. If you're EA, it's too big. You get venture dollars, them, Scopely, what have you. But the sweet spot in the middle, we call it like a Shopify, like for e-commerce. Like all the indie gamers that were creating games of some scale and then wanted to keep scaling. They had $500,000 and they wanted to go make 10 million bucks. So that was part of the scoping. A second scoping in that case was like, did you have a CFO or not? And that was a criteria that they were going through, and they eventually decided they didn't. Now as they've scaled the functionality, they do, because when you don't have a CFO, you don't have a finance person, so there's value. Now, if you do have a CFO, the good news is now a person you go work with, you could help them answer questions, and in this case, provide them capital. That's valuable. So again, you're sort of choosing these uncomfortably tight frames. I always give this very awkward example of my personal life when I was dating people. How I met my wife was I told my friends, like, I want to marry or meet someone who has red hair, speaks Italian, and lives within 5 blocks. And it turns out like that idea really focuses the mind. Even if Karen ended up not being any of those things at the time, it's so much better than saying, hey, it's nice and pretty smart, which she also is, very smart. But so I encourage founders to go through those constraints, and then basically you're just talking to those people like, is this a pain point? Is this something you need to solve? And then to go back to your how many is enough, it's usually smaller than you think if it's a real problem. To make up a concrete number, not to be prescriptive, but just to be precise, it's probably like 3, because you got like 3 people you can go work with, again, that fit your rubric, right? If it's like if you're making something for individuals, 3 is probably not enough, because it's 3 folks. You probably, I don't know, make a number up. It's like 25. People think it's interesting. I'm making a better note-taking tool. But if it's businesses, something of that order, because then you can go lean into them and you can both raise money on that basis. Like, talk to these people, they're indicative of my model. And then secondly, you can go build with them. And one of those isn't going to work out for some reason you can't control, but hopefully 2 will. And then you can create repeatability. lastly, what ends up happening from that is then when people ask you questions like, well, how much, tell me about what you're going to accomplish this year or the next 6 months. You can then say, well, we're going to have X number of customers like this, and maybe even Y number of these larger customers. And you can back very quickly and like how much revenue you're going to have. Not because it's perfect and exact, but like it's a basic rubric of the business. And that's ultimately what it comes down to, because then you can sort of understand what business you're going to be in and go from there.
Yep. So that's definitely something that our audience can keep in mind as we are moving towards the Q&A part, where we will use Slido for moderating some of these questions. I think I just had one last quick follow-up on what you mentioned, and that is you mentioned about some of the constraints to identify the right customer problem and then eventually the product market fit. So you had also touched upon this aspect that the co-founder, in this case Olia, who cared a lot about the climate aspect, and that was one of the, let's say, scoping restrictions that helped to identify, let's say, the area to go after. Yep. So how do the founders who have been successful, as you have seen, do this balancing act between, let's say, what's pertinent for the market right now and where they see this market heading in terms of their long-term vision? So how do they balance this out, especially in the early stage?
Minor clarification: Olia is building into the gaming market. We had another entrepreneur that was building into the climate market, but it's a relevant point to your question, which is, well, there's maybe two parts I'd say to that. The first is people need to build things that they're excited to build. Now, they might be more excited to go build a company because of who they're going to go do it with. Matt Gruber's an attendee. Me and Matt might be best friends, and we might be excited not to build like anything, but we might just be excited to be doing it together. So that might get you more motivated. That really shows up with founders. Like, I want to build a business with this person, and they're passionate about it. I just want to be on the journey with them. But so ultimately, you have to have passion for the thing that you're building or who you're building it with, and often those two basically come together over time. I've built anti-spam software, and I don't really like anti-spam software all that much, but boy, did I love the people that I built it with at the time. They were joyful folks. And so that's probably one part. You think it's an outcome of a good business effort. The business effort itself, I'll tell you, I think the answer you're looking for is you want to have an idea that you think is, in venture, in my job, that's big, it's durable, and it has the ability to scale based on the insight that you've got. So that could be in insurance space, it could be in the gaming space. Again, most of my stuff is in the enterprise space. We've got some really interesting new challenger banks, believe it or not, in this world of many challenger banks we've built. But something that has these attributes. Given that, I guess the other thing you could think about is there capital available to solve the problem the way you want? I actually saw a wonderful CEO the other day who wants to basically change out all the infrastructure in LA to better enable a really interesting autonomous truck fleet. The problem is that, like, the path from here to there is like, there's like 100 miracles that have to happen. Startup's already hard enough. You got to get yourself down to like one, maybe two miracles. And then, you get those two done, you get to the next thing, you get to the next thing, get the next thing. So I think it's less, in my experience, about the space and more about how you approach it. And you can see it from everything from like how, Travis approached cloud kitchens as a way of like doing food innovation that was clever, to companies that we backed that approached, building novel cameras in an area that should be a commodity. Like I'd be less scared that a space wasn't big, and more that can you get from like one logical step, say from the formation process to our initial customer, I can make that person happy and see how to go find more of them. And last thing I'll say is it turns out that's the game the whole way through, because once you've got, your first $1 million in revenue or dozens of customers or whatever the rubric is, it then becomes like the next question is just the exact same thing, except for you might be asking like, well, I know I can acquire customers, but can I retain them? Do people love this product? Maybe I can bring them in once, but I got different work to retain them. I know I can acquire for $1 and it takes me a year for that person to pay back. Well, that kind of sucks. Can I build organic traffic so that I can build product-led growth so that every person I acquire brings in 10 more, and therefore I reduce my cost of acquisition. And that just becomes the new problem you're solving. And below every single company, the wisest people will just tell you it's like one problem you're solving after the next. And you're just working against something that's pulling the market forward. Something about your solution is novel. Something about your solution is like timed right to the market. Or if it's not, that's when you need to like kind of to pivot that 10 degrees, 30 degrees to the left or right and find the bigger business. And sometimes, lastly, you do find like, well, for me in this time, I can't make this business work. Maybe I need to go pivot 180 degrees or whatever number we call it. And I'm going to go sell this business and do the next one. And that's part of the journey too. But that's certainly less common in the success in the success stories. But it's about how do you find the maximum value for the company and the approach that you've chosen at this time.
That's very helpful, Ross. I think just to summarize, it would be helpful for our future founders to focus on one problem area as they are going to achieve the product market fit, and then see how they can scale this into a larger vision that they might have for the specific sector. All right, so with that, let's move into the audience Q&A. And we see a lot of questions coming in at this point. I would encourage the participants to include their name if possible, because in that case, I could also provide you the opportunity to ask the questions directly, and you could unmute and turn on your camera feed. But at this point, the top one that we have is an anonymous one. So let's go for it, Ross. How do VCs typically evaluate startups? I think we did touch upon it a little bit, but the second part of this question is, which is the most significant factor or a deal breaker?
Yeah, so first I want to come back to my frame. So we're an early stage investor. So I think we're writing a check anywhere from $500,000 to $5 million. So to have a ownership in the order of 15 to 20% typically, just to sort of anchor where we are. And the reason that I mention that, we see lots of A's, B's, C's, D's, E's and onward is I think the biggest mistake people make in fundraising, which is common, is sort of about understanding your audience. So, if you're raising your money for your idea right out of the gates, and you've done this on the legwork that we've described in finding an insight and articulating who you're building for, well, don't go approach IVP, don't go approach, Summit, don't go to like the late stage growth people, go to folks like us that really specialize in doing early stage development for ideas. So I think the most important thing I would again highlight is this qualification for who you're talking to about your idea. One important reason is that you'll get more likely your investment. The second is otherwise it's exhausting. Like it's exhausting to go pitch your heart out to like someone like, well, we really don't get out of bed for less than 100 million. You're like, well, this doesn't make any sense. So I think that's one of the most important thing. In terms of a deal breaker, it's hard to give a specific one. I mean, there's things that you cannot like. For example, I believe that would make it a deal breaker. I believe there are a lot of nerds, a lot of developers on this call. I once had someone give me a pitch where they, this is a few years ago, and they were going to show me a demo. And they explained to me that they couldn't show me the demo because, like, oh, the development team, this technical CEO supposedly is like, oh, but you know, we were just compiling this, and we brought the wrong thing. I'm like, oh yeah, you compiled your Ruby code, huh? Really? You don't actually compile Ruby code, you interpret Ruby code, and like the step you're describing just doesn't exist. Is there a different problem? And then I said it in a nice way because I'm a nice person, but what was clear is that that CEO was just, it became clear, was just lying to me. Like, he didn't really know what he did. And I would have been totally fine if he hadn't already articulated that he did, and he had these technical insights. So that little bit of listening to real details and facts matter. The other places, example, it shows up, this is about the process. There's a huge difference in saying people are excited, I think we're going to get term sheets, versus saying we have a term sheet. Like, facts matter immensely, and you have to be very careful in how you articulate them. Another example that comes up all the time is, you know, people say, oh, well, we've got this person as a beta customer. You'd be shocked at my ability to like figure out who, reach out to that person and find out, are they actually a beta customer? Like, oh no, we talked to them, we think it's interesting. Like, those things matter a lot, and precision matters a lot, and that comes up a bunch, and not in a gotcha way. This is not like, you said you had 3 customers, I think you only have 2.5. It's really about being an honest person about what you figured out and what you haven't. And lastly, that also shows up when you ask people questions, and you've got to be really good to dodge a question. I mean, really, really good. If like, I'm like, how does this distribution work with this partner? And you don't answer it, all I take away is like, you can't answer my questions, I don't believe you. So it's an old, you know, it's the thing your mom or dad would tell you, but like the truth gets you so much farther. Like, we believe this, we believe that. Here's what we've done so far. Here's the next step. And those things are all like, that's where partnership begins and ends. And that's it for me. So.
Okay, yeah, that's really helpful. So the next question is from Manish. Maybe if you would, oh, so he has some issues. All right, so I'll ask for him. I think we touched upon it earlier as well. Are there some particular markets XYZ VC is interested in? Are you looking to invest in the legal tech market?
Yeah, I'll give you 2 comments and take them as they were. So the first is, well, so we primarily do fintech and enterprise, some exceptions. We have Roblox Game Studio because I think Roblox is an interesting platform. And we we have done and do legal tech. So that's the sort of the first vanilla answer. The second thing that I would say is, in legal tech, as an example, it's actually been pretty hard to make big businesses. There are exceptions, LexisNexis among them, but the reason is because it's the market dynamics of most general counsels of companies, not all, but most, have limited individual budgets, and most law firms are run by people that pocket the money that they make, so they're not super eager to spend more dollars, and a lot of times, again, not always, they're not seeking efficiency because there's some paralegal that's going to do work, and they get paid, you know, that person gets paid $200 an hour and they bill it 400 or whatever, pick your example. So a lot of this is, again, only if it's helpful for you, Manish, is that a lot of what's been interesting in legal tech of recent, including some stuff we've done, is where you can take take your technology and make it advantage to someone that does own a larger budget. Like, we are an investor in a company called Bond Terms that makes contracting software. It's, again, the procurement space. It's really focused on lawyers, but it gets paid for by heads of sales that are accelerating as a result of that. And so the comment is sometimes, but my view of legal tech is pretty consistent across the venture ecosystem. And so I'd encourage you to think about how you could take a different legal approach that then becomes, either expands access to budget or gets you somewhere else. And I really mean that even from the earliest days. It is possible to build better tools for lawyers. It is possible to raise money on it. It's historically been hard.
Okay, yeah, that I think that's helpful for Manish. We got the response. So the next one is perhaps related to one of the comments that you had made earlier, which is highly constrained. That's the word that we have in the courts. Seems to limit product market fit. What if the market isn't there because the number of customers that face the constraint problem is small?
Yeah. So the answer is then if you don't have customers in that constrained box, you have nothing. So my conjecture is if you have customers in that box, it's much more common or much easier than to expand that box. So to go back to the example I did in Mosaic's example, they had customers, but in their case, they weren't paying enough for it. So they need to expand the functionality they did to enable them, well, the expanded functionality enabled them to go up market when they went from reporting into planning as an example. So that's a shift that's going on. So that's a very normal process, but the constraints let you know, like, what can I do now? What can I prove now? Which customers can I go after? I would argue that most early stage companies, I would argue strongly, most early stage companies die because they're not constrained enough, not because they're only constrained and they build for a tiny number of people. If only because, like, if that's really your constraint, if you build something that is only applicable to, single engine planes that fly out of small airports in the Midwest, like, from the outset, that's a tiny niche business. Instead, the constraint process about how to help you all as founders dig through a big area and pick a place to start, break your pick, go get X customers this quarter based on initial product to expand from that. And sometimes, by the way, it's a really big build. Like, we've got an accounting system. We just never figured out how to do it in less than 2.5 years. I guess it's truly a huge build you have to do. But then once that build's done, you can really go do some powerful things to it. So, let's not overfit to my advice, but that's directionally right.
Thank you, Ross. Thank you, Ross, for that. The next question is from Nick Ross. And if Nick would like to ask the question directly, then that would be great. Yeah, so we can see him.
Hey, Nick.
Sure. Hey, Ross, how's it going? Yeah, so my question is, if you have any advice for early stage founders trying to raise money right now, like, should they try to have a low money strategy? Should they just be better at raising money? I know it's a tough time to raise money.
Gotcha. Have you raised any money, or is it as a first time?
Like friends and family.
Gotcha.
Yeah.
So my comment there is that it's still very much all the advice for raising money and starting a company isn't the same right now in this market. There are still checks. We're still doing new investments, and we're not uncommon. Early stage is one of the places that have been least impacted, and therefore what matters the same is how much money do you need to get to what, to take the major risks off the business. So the good news is it's basically the same game, the same activity. What has definitely showed up is two things. One is more skepticism. And so an example, not just like of any given company, one example of this that shows up in maybe in your business is if you're doing something that is either way out of the norm, like, hey, I'm making a robot for gathering recycling on the sidewalks, which I literally saw, which is fine, or something that's really in the norm but doesn't feel differentiated. There's more just skepticism. People don't believe it can be differentiated, or they don't believe that they should be joining this new category where before, when people were just kind of everything's exciting, and if we don't do Nick's deal today, like somebody else will, I think it's harder in that way. And the second place it shows up is purely in capital, and this is sort of writ large. In the early stage, what this means is we see companies that come to us and say, hey, we want to raise 5 million, and maybe that implies an evaluation of, I don't know, 25 million, maybe less, whatever. Or maybe they want to raise, 3, and it's day one. I will say to them, we've had examples of this, like, we love this idea. I actually think you could do a lot with $1.5 million. We could prove out a lot, and we would know if this was a bigger business. And so what's the lesson there? The lesson is, in many cases, is come in and think, what could I prove with less money? And then the last thing, and this is, again, only if it's helpful for you or for others, can be true, is with those two thoughts in mind of like, well, who really wants to do this kind of thing? And maybe I'm raising a little less rather than a little bit more because of this market, then that changes who I can approach. Versus when everything was buzzing and going to the moon, for example, we have a lot of companies that are based in Atlanta that were coming and raising in the Bay Area and raising more rather than less money because, heat, light, energy, or whatever. So they're raising it from Keith down in Miami, pick an example. Instead, we see more people right now raising a little bit less, and then maybe raising it somewhere where there's a little more familiarity with them, their problem space, their network. And that's what's going on. But again, the good news is the work is mostly just the work. It's a bit harder, it requires more qualification, and you're probably raising a little bit less, or you're raising a little bit more, or a little bit more dilution.
Thank you.
Okay, so the next one was actually very much related to this one. So I'll skip that one. And then this one is very interesting. What is your advice for someone who wants to join an early stage startup as an employee? How should one evaluate a startup as a prospective employer?
Two groups of thoughts. The first thought is they give to every single person I talk to, whether early stage of career or executive, which is pick a place you think is going to be fun 95% of the time, and you're going to learn something really transformative for you and your career. So that means there's advantages to who you do with, because maybe you're going to enjoy working with certain folks in certain environments, like remote, not, etc. And then really focus on like, what are you trying to do? What are you trying to prove? What are you trying to prove? It's hard as someone that passed at Google pre-IPO and passed at Facebook at 100 and Dropbox at 6, but still did okay. It's hard to know which one's going to make you the most money, but I think those two rubrics help you as a person. It's like, is this going to be fun? And am I really going to learn something very clear and meaningful that moves me forward in my career? The second part is maybe a searching process. So the searching process, what I've seen to be the most helpful, where maybe it's not, I want to go talk to my friends, not that I don't love them, but maybe I'm not confident that's a great company to join. It could be. The searching process I've seen to be most helpful is almost quite the opposite, but similarly, pick constraints of like, hey, I think I want to do something in this vertical, maybe, or there's a B2B motion or a technology stack that I know. And it's because I have some experience there. I have some ability to understand it. There's a reason that I'm going to be a good fit for that company. And then my honest take, and the best way to do that is to look at the best venture firms and sort of track back to look at the companies that they're involved with. Sometimes those aren't visible, and then you can have conversations with them. I mean, God knows we want to see talented people come into our door, and we'll direct them right to a company, or we'll direct them to a recruiter that's really good at it. But this is the case where actually it's the wrong word, but like pedigree is the thing you're looking for. You're looking for some hint that this is a good company in that category, and who invested in them or who is involved with it is one of the best indicators. So again, the seeking process I've seen people go through is actually the same kind of constraint process. Like pick a constraint, it might be the wrong one, and you're kind of hunting for people that have done companies that fit that rubric and go work there. It's both exciting and more difficult now when you can do that from anywhere in the world. So it's no longer like, well, what's the best company in Atlanta? Because I don't live in San Francisco. I like Atlanta, I'm not picking on it. They're great companies there, including ones like Saltbox and Parrot that we're invested in. But now the whole world's open. So like, well, where do I choose? And so I think I'm going to work in this type of B2B business that does this kind of thing. And I'm going to go look at other people that do stuff like that. That can be a good approach. And ultimately, that's a good way to walk a network. The more precise you can be. I want to join a company that's under 10 people, but raised some money, is in this market, and here's why I'm a credible person. Like, that's a great way to go.
Thank you, Ross. Really appreciate the advice. The next one we have is what's the next step after the 100+ customer discovery? I think they are referring to the customer discovery from a consumer standpoint, but I think the process is still the same.
Yeah, mostly it's two. Almost all the work on the consumer side. This is actually true in the business side, but it's usually less obvious. It's all distribution. It's all, what is the way that I'm going to go find more customers more cost effectively, and then keep and grow those customers. So we have a company of ours called SimplyWise, and SimplyWise makes technology that helps people, for consumers, organize their finances. Oh, we have another one called Daffy. Daffy's a great business. It's direct to consumer business to encourage everyone on this call to give to nonprofits, which you should do, whether a little or a lot, depending on your economic situation. So they're launched. They've got many hundreds of customers, thousands of customers. Terrific business. All the scale is figuring out, like, how do you get those people to refer other folks in, and how do you then grow the value that you're providing to those people? So the short answer is it depends, but it's these distribution mechanics, and the sooner you can think about them, the better. So some of those end up being what I call transactional referrals. Like, I'm going to invite somebody else because they're getting a benefit, I'm going to get a benefit. Dropbox was famous for this. Others are more like Instagram. Like, can you use your product to post your content somewhere else? Instagram, way back in the day, post photos into Facebook. How can you use your products to post into a known community, whether that's GitHub or whether that community is a Figma community or Reddit community? So again, you're looking for these non-organic ways to grow your business. It's possible, but rare, that people can acquire a customer on Facebook or Google and that person just pays back and you can build your whole business that way. It's possible, but uncommon. Like Casper and the mattresses did this years ago, and that wasn't defensible. But anyway, what's more interesting is how do you build these product motions internally. The business side, this is real briefly, is somewhat the equivalent. It just varies whether you're a HubSpot in an early stage business or a Palantir and you can't get out of bed for less than 20 million.
Awesome. Thank you, Ross, for that. So now we have a few minutes left for our chat today. The last question that we have is, how often would you consider investing in products which are a new something? So essentially product innovation. In essence, why would you think that a current market leader can't improve faster?
Oh, current market leaders are usually just, so, well, I was gonna say something blasé. The thing I think you want to figure out, so we do this all this time. So you want to figure out like why your company is deeply advantaged versus the existing player. So what usually we are looking for, and I would highly encourage people to think about, is what is the macro event that is changing in the market that makes your product deeply relevant? And is that something you can push energy into as a business? So you can ride that surfboard. So people know this, but like Slack really grew dramatically. It's a beautiful UI, but on top of Git and then GitHub. Atlassian did this through the open source community, and then later basically like chaining products on top of each other. So, but what you're looking for is this macro wave that's changing in the market that you can go and take advantage of. So Verkada, as an example, is a product that makes a internet connected camera. So camera like a domed camera you see at ATM or outside your office building or a home, a school, retail establishment. And what they did is that's a large market dominated by commodity vendors, and they believed there was an opportunity to build a beautiful software managed solution for those products. Long story short, they were just correct. It turns out there was a huge pull from customers that wanted to be able to manage all of those cameras. Now, cameras were also proliferating very quickly. Computer vision was getting simpler and simpler because it was getting published into the open source community by Google. So they benefited from that. They didn't have to invent things. And the team is just unbelievably sophisticated at implementing their go-to-market. All of that said, in year one, when we thought it was going to be goddamn hard and we would do like, I don't know, $1 million, because how often do people reset their cameras? It turns out if you build a beautiful product and you're talking to the general contractors that go install it, they react really positively. And I think we did like something like 5 or 7x as much revenue as we thought we were going to do, just because there was so much market pull. So again, what I think usually we back it all the time. So, and we're just looking for that macro change. And it's not always obvious. I backed Anduril, which is a new defense contractor. It's still working through the enemy that is the primes in terms of like how they buy software, and that's a process. And even to go back to Manish's question about legal tech, there are a lot of entrenched interests in all the sort of entrenched business models. So you want to figure out something that's new about your thing, and it either needs to be a 10x better product, which is uncommon but does happen, or more commonly 10x better solution or go to market, or something that has its own market pull that you're just riding on. You're on that surfboard, happy to be in that wave, but you spotted that wave was coming. And frankly, we back those companies all the time. What we're looking for is entrepreneurs to come and explain to us like, hey, this thing is shifting. Let me show you how, and let me show you how we're going to get in position to be on top of it.
Thank you, Ross. That's very exciting. So that's a perfect way to end our fireside chat today with Ross Fubini. And we would like to thank everyone who was part of this discussion today. And I think that, if anyone wants, we can share the best way to reach Ross as well through our email channels. And with that, I think I would like to say, okay, so I think someone has mentioned that, Manish has mentioned that. We'll surely do that. And with that, I would like to close for tonight. And definitely thank you, Ross, a lot for sharing all these insights with our CMU TNE community. I think they would definitely be valuable for our future founders, and really appreciate it. Thank you.
Thanks, everybody.
Thank you. Take care. Bye-bye.